but I'm afraid we continue to have to talk about central banks. Today we had a huge surprise from the Bank of Canada and arguably not a big enough surprise from the European Central Bank. To start with Canada, the commodity price fall has obviously damaged the Canadian economy. It raises the risk of deflation there, and so today the Bank of Canada cut interest rates for the first time in 6 years. Literally no economist who tracks the Canadian dollar was expecting that. The result was a fall of more than 3% for the Canadian dollar against the US dollar. Quite dramatic. In Europe, the ECB meets on Thursday. Everybody expects it to launch some form of sovereign QE bond purchases. The FT's information, which has been disseminated during the day, is that it will probably involve purchases of 50 billion euros per month, very similar to recent Fed policies of QE. Now, let's take a look at what that has achieved. If we take a look at inflation break-evens for Germany compared to the ECB's balance sheet, which very controversially has been contracting over the last couple of years, you can see that as that balance sheet contracted, so you saw the deepening deflation scare. What we've seen today has been a tick up in those break-evens, so that they're now very slightly positive, above zero rather than below zero for the next 5 years. That has to be of some comfort to the ECB. Also, if you take a look at stocks, the FTSE Eurofirst 300 stock index is now at a fresh post-crisis high in euros, although certainly not in dollars. If you look at other measures, however, it's harder to work out exactly what is going on. The euro has very slightly strengthened for the day. Bond yields have ticked up somewhat in Europe. Now, let's look at this in context. There are arguments that it may not necessarily be the best idea to featherbed the market, to make it as clear as this what you're doing in advance, and to move gently. For a first example, let's take a look at QE Infinity. It started in 2012. Regular bond purchases indefinitely, well signposted in advance to try to combat deflationary fears. And as you can see, inflation break-evens were actually higher when the program started in 2012 than when it ended in 2014. It's hard to say that the final QE program was a great success that way. Perhaps more concerning, let's take a look at monetary policy in the run-up to the credit crisis in 2008. The policy of the Fed under Alan Greenspan at that point was to raise rates extremely consistently, predictably, and in very small steps, 25 basis points a time over a matter of years. People could set their watches by it, and as you can see, the result was that 10-year bond yields barely moved throughout that period, and similarly you could say the same thing for investment grade corporate bond yields. Alan Greenspan himself called it a conundrum. Part of the problem with making that tightening in rates so gentle was that it didn't disrupt the credit market as it built up towards what would turn out to be obviously such a terrible credit crisis. In general, markets dislike uncertainty. You don't want to create too big a surprise, as perhaps the Swiss National Bank showed last week, because it can shock markets. But sometimes, if markets are set into behavior you dislike, as they were under Greenspan ahead of the credit crisis, or as they are now in Europe with bond markets signaling deflation, perhaps it would be wiser to try to shock them out of it and avoid the risk of an even greater dislocation afterwards. One final point I'd like to make as we wait for the ECB. At the moment, one point that everybody almost seems to be taking for granted is that the US economy remains strong and that the Fed will be raising rates later this year. That will be a moment of great tension when it finally happens, but I'd like to suggest that that narrative is now so strong that if you really want a dangerous surprise for markets, it would come if the data weaken or if the Fed hints that it's not raising rates after all. That really would put the cat among the pigeons. Now let's wait for the ECB.